I have to say that I have this classic what me worry Alfred E. Newman feeling when I look at the action in the equity market and the reasons for this absolutely relentless exuberance. For one, when I hear that this is an earnings-driven rally, I practically chuckle because if this was all about earnings growth, the arithmetic shows that the S&P 500 would be sitting at 4,800 right now, not 5,600 and change. The reality is that over the past year, this power surge to new highs has actually been 1 part earnings growth to 3 parts multiple expansion that's taken the forward PE to 22 times and the equity risk premium to a razor-thin 30 basis points, which is basically 1/10 the historical norm. Ergo, this goes down as the top decile in terms of valuations of all time. We have market vein at 70% bullish sentiment, which is right at the peak levels of extreme in terms of investor animal spirits. So we have the Charles Mackay backdrop on our hands of extraordinary popular delusions and the madness of crowds. And that, by the way, is a masterpiece I recommend everyone buy on Amazon and read. Now, my greatest concern is how nobody has rebalanced their portfolio in this last huge leg of the stock market rally. It's as if diversification has emerged as a dirty 15-letter word. The U.S. household balance sheet is now more than 70% concentrated in equities, which takes out the bubble peaks we had in our hands in 2000 and 2007. And what's even more amazing, actually disturbing, is the fact that for the retiring baby boomer community, over 60% of their asset mix is in equities, which is double where it should be at this stage of their life cycle. Not just that, but couple it with the fact that over half the stock market today is in passive indexed funds. So we have double concentration on our hands. We have extreme concentration of equities on individuals' balance sheets, and within that equity tranche, the most concentrated market in a handful of stocks that we last saw during the tech mania in the late 1990s, and we all know how that turned out. But you can't warn anyone at times like this when everybody lives in the moment and extrapolates the current environment into the future. But the demographic risks this time around and the heavy participation by those over the age of 60 in risk assets at nosebleed valuations is a deep concern for me. So the stakes in the next bear market are high because the baby boomer class is this 80 million pig in a python that's been the dominant force in the economy for the better part of the past 5 decades. So the next bear market, and it's not a matter of if, but it's a matter of when, because market cycles, like business cycles, don't ever get repealed. So the next bear market, whenever it happens, is going to carry with it a retirement crisis of epic proportions, and nobody talks about this except for yours truly. Now, just a word on this most recent move from growth to value, because it is interesting that the markets have behaved very well at the headline level of late, even with the Mag 7 showing signs of sputtering. The shift to the value trade and the small caps has been unprecedented over such a short time period, but from my lens, there's nothing fundamental or rational here, and I see this shift as more of a trade than a trend. Maybe we can boil it down to the Trump trade, but the election is on November the 5th, and again, comes down to pure speculation. I think it's actually more of a short squeeze in these previously unloved stocks, but value and small caps tend to be positively correlated to interest rates, positively correlated to inflation. value and small cap stocks positively correlated economic growth. And all of these three, interest rates, inflation, and growth, are actually headed in the other direction. So my advice here is to look at this latest shift from growth to value and from big caps to small caps with a high degree of skepticism. And while you're at it, diversify into other geographies like Japan, like India, which we've talked about repeatedly the past several years. These areas of the world have secular tailwinds. And I continue to pound my fist on the table, as I have for many months now, Treasury notes and Treasury bonds, since the Fed easing cycle is soon to be upon us. And we have this situation now where the most cyclical segments of the CPI in both the goods and the services components are deflating. Not disinflating, deflating outright. And Fed rate cuts will translate into a weaker US dollar. And with that comes an extension of the bull market in precious metals. In other words, the bond-bullion barbell is alive and well and deserves consideration in anyone's asset mix, especially at this time. And remember, diversification is not a dirty 15-letter word, but a prudent risk management strategy to limit the downside while still participating in the upside. Let me leave it there, but if you would like to tap me for more insights, email us to information@rosenbergresearch.com, and we will get you on a free trial for everything we do at Rosenberg Research.